Good morning, everybody. Welcome to the Reserve Bank and welcome to our monetary policy statement for September. The Reserve Bank has this morning determined to cut the official cash rate from 8 to 7.5%, that is by a 50 basis points cut. The global outlook that we see today has deteriorated significantly over the last quarter in the wake of continued international financial market turmoil. In addition, we've seen the New Zealand economy start to experience a marked slowdown led by the household sector here. In addition, New Zealand business is coming under more pressure from higher costs and from softer demand. Overall, this implies that we are now going through a period of household readjustment in New Zealand, and it's a period of below average growth. We do, in our forecasts, see a pickup later in the year. This is primarily driven by tax cuts, by government spending, by stronger rural incomes, and also by softer monetary policy. This year, food prices, the softer exchange rate, and wage cost pressures has still left headline inflation elevated. In fact, it's peaking, we believe, just below 5%. Approximately currently. After that, we believe it tracks down. It's both weaker macroeconomic activity and also the beneficial results of past monetary policy that do mean we now have a track for lower medium-term inflation pressures. And it's consequently, as a result of that, we think it appropriate to be able to move to a less restrictive monetary policy. We've brought our profile of interest rate cuts forward a little, but we haven't altered our overall expected decline in the rate schedule. We believe this front-loading, if you like, of the cuts has been warranted by the tight current credit conditions that we see, and also by the time that it can take to actually affect market interest rates both for the household sector and the business sector. What lies ahead? Well, we say that the scale and the timing of future OCR cuts is going to be dependent on us seeing evidence of reduced inflation pressures. It will also depend on any developments on the exchange rate. Thank you, ladies and gentlemen. That's the end of the formal press release. We're happy to take any questions. To help me, as usual, I have Dr. McDermott, our Chief Economist, and Tim Hampton, the head of our forecasting team.
Dr.
Questions?
Bollard, are you applying a cattle prod to the banks here to lower their mortgage rates? Is that the message you're giving?
The banks will reach their own decisions about what needs to happen to mortgage rates, but we think we're giving quite a lot of room to for them to make decisions, and without having a strong view about what's going to happen. There are, of course, a very wide range of rates out there. We would expect some of this to certainly pass through and trigger mortgage rate reduction.
I expect the dollar to drop on this news. How much of a drop would be excessive in your view?
Look, we don't have a particular number. We're all aware that excessive and speedy reduction in the New Zealand dollar is damaging to inflation, and that clearly means that we've got less room to move when that happens. We haven't set a particular figure. We observe, of course, that on the FX market, what's really been happening has been very major day-to-day changes in the US dollar. We tend to have been moving in the Australian dollar shadow over recent weeks.
Was much consideration given to cutting by 50 basis points?
We did cut by 50 basis points.
Was the size of today's cut an indication, is it an admission by you that you've tightened too far in the past?
No, I don't think so. I mean, if anything, it's a recognition of the fact that New Zealand has been one of the central banks that has run a classically tighter monetary policy during the upswing, and therefore we think we've got room to move in a downswing, and it's evidence of that. So in a sense, it's a dividend from that.
Did the recent fall in oil prices make this decision easier for you?
Well, I guess we've seen several classes of things happen with that softening in the world economy. One is the fall in oil prices, and yes, of course it does. We don't know where oil prices go. I think you'll find forecasters have all got things quite wrong in the past and are quite hesitant about where they take their forecasts. So we're all rather conservative on that, but yes, that absolutely makes things easier. At the same time, of course, that has been associated with a stronger US dollar and with weaker commodity prices, and we have to factor all of those in.
In your overview, you discussed macroeconomic imbalances. Are you talking more about housing market or the current account resolving there? You say that macroeconomic imbalances are unwinding at this point. Which ones in particular?
Well, I think we've seen a connected set of imbalances that relate to household balance sheets, lack of savings, the household sector asset bubble, the housing asset bubble, and the current account, or the size of the current account deficit. So they've all got an interrelationship in there, and we're talking about that whole bigger picture.
How serious are the risks of us falling into a deeper recession at this point? I mean, the graphs are looking very ugly. You're anticipating a good quarter in the final quarter. I mean, that's guessing work, isn't it, at this point?
No, actually it's not guessing work, it's a forecast. But what are the chances of that being wrong? Well, I mean, of course there's the possibility of that. Our activity profile is that Q1, Q2 and Q3 are all mildly negative. We expect to see a pull-out at that point. Actually, I think the risk really is whether we have a weak pull-out or a stronger pull-out, rather than whether we have a pull-out.
Is there less likelihood now that we'll see a cut in October?
Less likelihood than compared to what?
Well, you said you'd advanced your planned cuts to today. Does that mean there won't be one in October, or is there less likely to be one in October?
Oh, look, we've made decisions for today. We don't know what we're going to do in October, but the market picture on forward track of rates has been that we head down a little bit of a staircase, and you can draw your own conclusions from looking at our 90-day graph there as well. So, I mean, I wouldn't speculate beyond that.
At what point do 90-day bills stop being contractionary in your view?
You're talking about...
You say that in your statement that we're still experiencing contractionary interest rate levels.
Yeah, sure, from the effective mortgage rate, which has been pushing up. Do you want to, John,
Yeah, normally you can simply just look at the 90-day bank bill and that will give you everything about monetary policy. Right now, what's going on in international markets means interest rates are moving in different directions. So it's important to realise that even if the 90-day bank bill just simply comes down gently, the market rate that businesses and households will face could actually be increasing, and that's really what matters.